Features of formation. There are features when starting a business entity, such as sole proprietor, limited liability company, S Corp, C Corp, or even a nonprofit, that are important to consider that could be important to the entrepreneur or business structure. And what we will discuss in this section is ownership, the reasons to create a business, liability, financing or raising funds, profit distribution, taxation, and paperwork. Those features are important considerations on what type of business entity you should set up. And depending on what are most important to the entrepreneur or owner or investors or anyone who is a stakeholder in the business to consider, because these are what may help guide the business structure chosen to launch a business. So one of the questions that we want to ask is, what is a corporation and how is that different than an individual running a business? We discussed in the last video, Erica was interested in starting her graphic design business and she created her own business card. Okay. She has done no paperwork to get it started. What type of business formation does she have if she starts working on a logo for a customer in exchange for money? So she has done no paperwork, but is engaging with a customer. What kind of business does she have? Is it a sole proprietor, a limited liability company, a corporation, or D, it is not a business yet? Which one is she? The answer is she's a sole proprietor. Even without doing paperwork, she has started her business. She may have not filed all the paperwork that she needs to do, but she has started a business. When you run your business as a sole proprietor, there is no difference between you and your company. You are one and the same. Erica, as a sole proprietor, starts a business doing print and web design, and she's engaged with Enrique in a customer business relationship. Okay, so Erica and Enrique are working together, and they are working to help Enrique design a menu, signage, and a website for his restaurant. When they become engaged, and I'm not talking in a marital or relationship, I'm talking about a customer business relationship, there is a contract that is created between the two entities, Enrique and Erica. When a customer and a business do business together, a contract or agreement is made between the two identities, even if it is not written down. And so this is important to consider because this contract will bind the two entities together until there's some resolution or until it's concluded. So some of the reasons to start a business are you want to start a business to make money or profit. There might be a public benefit or nonprofit purpose. The reason to start a business may be to reduce liability, raise funds, create an income for the entrepreneur, or self-employment. So rather than working for someone else, self-employed people can create their own income out of their business. They may launch and run the business to make it profitable and sell it for a larger sum of money. They might want to create a structure to share activities with a partner, to raise money from investors, or for a public service such as a church or homeless shelter. Liability is the responsibility for the consequences of one's acts or omissions enforceable by civil remedy or damages or criminal punishment. So what does that mean? If there's a disagreement in the contract between two parties, and let's say for the example between Erica and Enrique, Erica prints 1,000 menus and all the signs for the restaurant, but Erica misspells Enrique's business's name on them. Who would pay for the reprint? If they are entering a disagreement, the liability is who is responsible for paying or coming to the conclusion of who is going to fix the problem, okay, in order to fulfill the contract. So that was a minor disagreement, and it may cost a considerable amount of money to reprint the menus and the signs. But we always want to think about what are some big liability issues. There's always the potential for a large sum of money to be considered a disagreement. So for example, in the same amount of work that she had in her contract, if Erica accidentally uses a photo of a child without the parent's permission in the menu and in the advertising and in social media, and the parents of that child sue Enrique or Erica's business for damages of $25,000, who gets sued? Would it be Enrique or Erica? So the question is, who pays for it? And in a contract disagreement, this is often what happens. There might be a disagreement, and without a properly written contract, there's always going to be conflict between the two. Even with a properly written contract, there may be disagreement. But it's important when we're setting up a business to reduce the liability in a number of ways, and there's a number of strategies we can employ in order to reduce the liability. One of the ways is reducing the liability through incorporation. What is incorporation? It is a way to shield a business from personal liability. So is Erica personally going to be liable for defending that lawsuit? Is it going to be Enrique? If Erica takes some steps to incorporate her business, she may have a greater chance of protecting her personal assets, her personal resources, and deflect them to her incorporated business. So a corporation is its own entity. And so I used the image of armor, a suit of armor, and it's not necessarily that something that goes over her, but it's almost like it's its own entity. It's its own person. It's its own being. Okay, this business. And this is because it could move on. She could transfer that business to her children, or she could sell it to another party and it can live on. And that is a word that's called, or a term that's called going concern. And it's a going concern is a basic business principle that means the company will continue on into the foreseeable future, often past the ownership or lifetime of the founders. So in this developing an incorporated business, Erica is taking steps to place the liability from herself personally onto the business. So what does that mean in simple terms? It means when entrepreneurs create an incorporation, they're reducing the liability because the entity that is engaging in the customer business contract, the entity is the business rather than her personally. So even though she's operating the business and running it, if something ever happens, it's the business that takes the responsibility, takes over the liability, if she sets it up right. So Erica is not her business. She can own the business, she can run it, but she is not part of a business when she incorporates. So if her company gets sued, does Erica get sued? No. If she sets her business up through an incorporation or even a limited liability company, it's not her that gets sued, it's the company that gets sued, even if she is the one that owns and manages the business. By forming a separate entity and careful management, Erica can reduce her personal liability. Financing the business, raising money. How can a business raise funds? It can raise funds often by borrowing money. It can get credit from a supplier. It can get an investor, or it could bootstrap the business. Distributing profits from the business. There's a basic business term or equation that says revenues minus expenses equals profits. So what happens when the profit is made from a business entity? How is it distributed to the owners? So for example, if Erica's business creates $100,000 in revenue or money coming in, and $75,000 in expenses goes out, and there's $25,000 left over in profits, how is that profit distributed to her or the other owners of the business? Does she get to keep all the profits? Well, the answer is a tricky one, and often we recommend employing or engaging with an accountant that can help you answer these questions. But when you have an entity, there is a structure of how those profits are distributed to the owners. And so the owners of an entity don't always get to keep all the profits. It depends on if the profits are kept in the company or not, or who would pay the taxes on those. So how can Erica take money out of the business? Well, there are different ways, depending on the type of business entity that she sets up, of how the money gets distributed to her. One very important consideration of the business structure is how taxes are paid. And the Internal Revenue Service in the United States is the federal agency that governs taxes, of how those taxes will be paid. And each state will handle the state taxes as well. But the IRS, the Internal Revenue Service, is the federally run agency that governs how taxes are paid from businesses. As the owner of her company, how does she pay taxes? On profits. So generally businesses do have to pay taxes on the profits that they make. So how does she handle her business's tax? Does she pay it, or does the entity pay it? So again, that depends. If she's running her business as a sole proprietor and there's no difference between her and her business, she would pay her taxes through her Schedule C on her personal tax filing. So in addition to her regular personal taxes, she would fill out a Schedule C form, which is part of that, and it would explain how much money she made, $100,000 in revenues, what her expenses were, and how much her profits were, and then she would pay her taxes that way. If it is an entity that she's created, depending on the type of entity, either the entity will pay the taxes or the responsibility of paying the taxes will be passed on to Erica to pay those taxes personally. Okay, so this is an important structure of how the different entities are set up. If she sets her business up as a C corporation, she will experience double taxation when the business pays taxes or profits directly to the government. And Erica would then pay taxes on any profit that she takes as a distribution to her on her personal income return. So it's called double taxation. It doesn't mean that she would pay double the taxes as she would as a sole proprietorship. It just means that taxes are being paid in two different ways. So you may hear the term double taxation. Again, the amount of money being paid in taxes is an important consideration because the way you structure your business entity may be more or less taxes depending on how you structure it and how much money is distributed to the owners. The term paperwork and what is required for their business is another consideration to think about when starting your business. Some businesses, entities are simple to file all the paperwork, and some of them are more complex. So paperwork is a simple term for all the legal requirements to start and run your business. So it's important to note that there are different levels of government that regulate the paperwork that businesses have to file. There is the federal level, which covers all 50 states and other areas. They govern what the business has to do. There's state regulation that governs the rules and regulations and paperwork you have to file in your state. So for example, if you set your business up in California, their rules and regulations and paperwork will be different than Nevada, which will be different than Arizona and New Mexico. So there are slight differences between each state level on the amount of paperwork that needs to be filed. And also the local level. So if you set up your business in San Diego, then you might have different paperwork there. So an important consideration is where your business is going to be set up, and that will help define the paperwork, no matter what type of entity you form. Often there is confusion on what are the requirements. We'll discuss more about the paperwork in Module 3, but it's an important consideration to know that different entities have different amounts of paperwork. Next up is the legal forms of organization.